This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
The macro is fading us, the data is changing the story, the market is starting to price in what it didn't want to believe. So we'll try to move on, we'll move past it. We're going to try to focus on some earnings this week on the Wise Investor Show. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein, one of the portfolio managers on the team. And while I do promise to focus more on individual stock names this week, as I have happily a wealth of material to choose from after a flurry of earnings results released from the names that we follow. But I'm going to start off, I do have to pay at least some lip service to the big picture, the markets, the economy. After a really volatile week, it's been a volatile month, which means it's gone down. Which saw the major indexes actually pull back. The S&P still up roughly, let's say 5%-ish for the year, but the Dow and the equal-weighted version of the S&P are just about flat for the year right now. And interest rates are rising. The last count, when I stepped into here today, 2-year Treasury now yielding over 5%, and the 10-year nipping at that 5% number, but 10-year Treasury now yields 4.64%. That is 20% higher in yield than it was when the year started, January 1st. And then what started my week off was a headline article in the Financial Times, which I recommend as a financial newspaper. FT said that, well, basically what we're all thinking, and, you know, what I've even said before on this podcast is, quote, Financial Times, quote, investors price in growing chance of another Federal Reserve interest rate rise, end quote. In fact, you know what? That might not be fair. You know, I have been on the conservative side. I've been saying the market expects interest rate cuts and the data maybe doesn't justify it as much as the market thinks. Not that, the conditions just don't demand interest rate cuts, but I don't think I've actually come on here and been as bold to say that I expect them to raise interest rates this year. But per that Financial Times article from, actually it was Tuesday the 23rd here, quote, while the base case remains reduction in borrowing costs, options markets shows a 20% probability of increase, end quote. So as the market took off in November last year, remember September, October was kind of nasty, kind of a mini correction. Then the market just takes off in November, and valuations expanded as bond yields began to fall in anticipation of interest rate cuts this year. By some accounts, expecting up to 8 rate cuts this year. And then what are we to expect if we're now going to make a baseline expectation that we're not getting interest rate cuts? Maybe there's still rising chance of a rate hike. Well, all things equal, it should look something like unwinding a good deal of that valuation expansion, only therefore allowing the stock price's appreciation from point to point due to earnings increases. So basically, all right, if earnings have increased, and we'll get to that in a second here, over the last few quarters and your expectations for earnings are going up, the stock price should reflect that, not just a valuation expansion on top of that. And it can't be literally that succinct, but that's what it's looking like today. However, oddly, maybe perversely, I am then therefore getting that much more bullish as this is unfolding. Now, it's not just that I want to be an outright contrarian here, but as some of this air is let out of the balloon in the market, then value is surely going to be returning to some degree. And while it's not a foregone conclusion, that so-called soft landing is now about to be attempted. You know, Jamie Dimon, CEO of JP Morgan, said this week that a soft landing in his mind is unlikely, but the data really may be suggesting otherwise, despite what you're seeing in stock prices. Now, if you remember that stock prices are pulling back, not because they're worried about earnings going down, but if stock prices are pulling back because they're not going to get that free lift from interest rate cuts, but otherwise businesses are generally good and the economy is good, then don't get too wrapped up in 1 month's return on stock prices, as sometimes that's what a real correction is. It's fixing the price the price that may be to a degree broken, meaning the price of these assets, rather than suggesting that the asset itself is broken, that the business isn't executing or performing well. It's a correction in valuation. And this week's a tough podcast to record because I'm doing this before the PCE numbers come out on Friday. And that's the cherry on top of what all this macro data is building up to. That is the quintessential inflation data point. It's what the Fed is going to look at and what will set market expectations for inflation and rate cuts. So I don't want to paint myself into a corner here before that's released, but if we're about to attempt this soft landing, if the ship is maybe a few hundred feet above the runway and on a decline, the gears down, and we're on our final approach, but no doubt with some really tough crosswinds. Well, the landing is right ahead of us, and this is what a soft one would look like before it occurs, but still not promised, right? Thursday was characterized by some very strong jobs numbers, which bolstered the case for higher rates for longer, paired with disappointing GDP growth numbers, as the initial report for the first quarter came in that with U.S. GDP below a 2% growth rate. So we're going to move on and talk about the fundamentals of some stocks because, like I said, the economy is not rolling over here. The bottom line is that the market is giving up some hot air because it's not going to get its sugar fix in the form of rate cuts, and it's not getting what it wanted because the economy is remaining too strong. So valuations are being reeled in, and while some businesses out there are struggling and some are just not executing, but for many of the ones we're following, they're delivering on expectations, and in some cases, they're doing so while being offered now at a cheaper price than they have at least over the last few months or 6 months or so. So let's start off first today with Merck, symbol MRK. And they announced their first quarter results on Thursday morning. Maybe not the best place to start because they're not getting a discount in what this broader market sell-off is. As I speak, they're trading at about $130 a share, and their 52-week high is $133 a share. But they're on the forefront of my mind because, as you should know, I own it. We own it for our clients' managed portfolio, so therefore we have to disclose that I have this conflict of interest here. Obviously, I like the stock, but I would also theoretically be incentivized to hype it up here. But, take it in stride that you shouldn't take what you hear on the show as a given, but you're listening to get a feel for my perspective. And with Merck, it's been a hard charger for a while now. Like I said, it's near its all-time high. And their primary drug, Keytruda, well, it continues to get more applications for effective treatment of more and more various forms of cancers, usually taken in conjunction, and I'm obviously no scientist nor a physician, but taken in conjunction with the more traditional therapies like chemo, it's giving lots of cancer patients better outcomes. And with that comes some long-term risks. So here's the downside. One reason that they really have done well over the past 3 or 4 years or so is because a similar approach being developed by a competitor completely failed. It didn't get FDA approval, and Keytruda ran away with the market, actually becoming the top-selling drug worldwide in 2023. Now, Keytruda is now almost half of Merck's total sales this year, expected, according to FactSet, to bring in close to $30 billion in sales, which is almost triple what that drug did 5 years ago. And while this patent cliff is still out there, it's 5 years more, it's a cash machine until then. So that's one problem, right? You're getting great cash flow from it now, but in 5 years, it's not going to go away. But it starts going, shouldn't be called a cliff, especially with drugs like this. They're harder to replicate. But it'll start being eroded by some form of generic competition in roughly 5 years, unless they manage to extend that a bit, which they certainly try to do. But to be more specific, the consensus estimate is that they're going to do about $30 billion in free cash flow as a company this year, and using about $7 to $8 billion of that cash flow to pay out a dividend that, based on today's price, yields about 2.5% today, according to Value Line. Now, that dividend, according to them, also is expected to grow by about 7% per year. And then the question becomes, with the other 20-some-odd billion dollars that they're amassing each year, what can they do or develop or buy to add onto the portfolio to ultimately replace and exceed Keytruda. According to JP Morgan, in their response to the quarterly earnings, I didn't mention those actually. Merck earned $2.07 a share here in the first quarter. That was about 10% higher than the estimates. And Merck raised its top line and earnings guidance for the full year. Anyway, JP Morgan is saying that Winrevair, now they have a scientific name for these drugs, and then they have the branded name. The branded name I can't ever pronounce. I mean, Keytruda is not that bad. I don't know what it means. But Winrevair is the new drug on the market, just got FDA approval. And JP Morgan says that's the next thing that's going to be impactful. It's not going to keep up with Keytruda. It's probably going to be about 10% of the sales of Keytruda this year. But JP Morgan expects this, which is a hypertension drug, to quickly ramp up and to exceed sales expectations. Their response to the quarter was that, quote, "We continue to view Merck as having one of the cleanest paths to upside to both near-term and longer-term numbers in the group, and we estimate double-digit earnings per share growth through the late 2020s. And with share, now I'm starting to paraphrase a bit, and with shares trading at only 14 times our 2024 estimates, we see Merck as well positioned," end quote. The report goes on to point out that Keytruda sales grew by 24% year over year for this quarter. Goldman Sachs also carries Merck as a buy, but with a price target that's actually only a bit above today's level. That's interesting when you see that because it means two things. Either they're going to change it to a neutral, but more typically what you see on these sell-side analysts on Wall Street too is as companies burst through their buy targets, they raise their price target. So it becomes a kind of this ironical catalyst for the stock, which is ultimately meaningless. Anyway, Goldman points out similar factors on guidance, Keytruda and the Winrevair launch. They also go on to point out that Gardasil, which is an HPV vaccine, is contributing quite a lot now and ramping up. Importantly, ramping up sales of Gardasil in China. So there's, a lot of prospective patients over there. All in all, it was a clean and solid quarter, and the stock stood out this week. It is about 14 times its forward consensus estimate right now, and that's actually about the middle of its typical range over the last decade. And that consensus has, according to FactSet, been raising estimates. The estimates for earnings for 2025, 26, and 27 has actually been ramping up, which is how you can see a stock have its valuation actually within reason while the stock is at its all-time high. So the bottom line is at least a solid hold here, I would say, maybe even a trim if it's badly overweight for someone, but something very comfortable to hold on to, a lot of visibility into earnings when everything else out there seems to be about artificial intelligence or whatnot. Okay, I'm going to take a quick break here, but a couple of more updates when I return. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
The political temperature is only going to get hotter. It doesn't mean you need to lose your cool and make emotional decisions. I'm Simon Hamilton, Managing Director and Portfolio Manager with the Wise Investor Group of Raymond James. Every week, we discuss the latest financial trends and what investors need to know. To help filter out the noise distracting you from sound portfolio management and how to become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. And let's get right back into it. Another name I own personally and we own for our clients is Danaher, symbol DHR. Company based nearby here in Washington, D.C. In fact, it was founded in the late 60s as a real estate investment company. But by the 80s, it started acting more like a holding company, an investment company, purchasing medium-sized tool businesses, manufacturing businesses, and then ultimately evolved into what they are today, which is now actually a pure play on the life sciences industry. They spun off their last non-conforming business last year. And it's a company now that owns dozens of businesses, but they're all involved with selling the equipment, the gear, the filters, the stuff that you need to keep buying, and the software used to develop therapeutics and also to diagnose diseases. And on Tuesday night, Danaher released their first quarter results with earnings of $1.92 a share versus the FactSet consensus estimate, which was $1.72 a share, on revenue of $5.8 billion. Versus $5.62 billion expected. In their report on the quarter, an analyst over at RBC said that based on this quarter, he believes that the full-year guidance appears conservative, and he raised his price target to $297 a share. That's about 20%, a little bit more than 20% higher than it's trading today. And he maintained his outperform ranking. Funny quirk about Danaher's results is they are still generating revenues from testing for COVID. Amongst these diagnostics, they sell COVID tests or things that are used for that. And it's always nice to have more revenue, but it kind of junks up the numbers a bit because the quarterly results look disappointing versus the recent past because they can't compare with what the demand was during the pandemic. But still today, basically, Danaher's guidance and analysts back out any real revenue at all and estimates from their forecasts when it comes to anything COVID-related. And then when you still see some revenue coming in from there, it just becomes, I guess, icing on the cake. But still, along with those lines, but not related to COVID, Danaher's Cepheid business is growing into a bigger and bigger piece of the pie. And they bought Cepheid back in 2016. They spent $4 billion to buy them out. And today, it's generating $3 billion in sales a year. And while I don't know their specific margins to that division, Danaher overall generates 25% margins. I actually think Cepheid is higher than that average margin. But even if we assume 20% margins, they're getting $600 million a year on that $400 billion investment, which is great. And it's growing nicely because this is the must-have equipment in hospitals. If you are looking for a diagnosis, this is the way you get a quick turnaround. Like you get your diagnosis on what's ailing you in a couple of hours, where the more standard traditional solutions might take at least a day or more. This beat in the first quarter, according to both analysts at Stifel and at KeyBank, was driven by better than expected sales within Cepheid. The latter of which, the KeyBank guy points out in his report that Danaher is coming up on a period of easier comps. Maybe that's related to that COVID business, and that they think that the estimates are going to be easily beaten. And he has a $290 price target on the stock. Again, the numbers are a bit hanky. There's the COVID tailwind running off and the recent spinoff. But through the noise, it's trading within a normal to a bit actually below normal valuation range, and we still generally like it here. Moving on, last one for today, and we got the results from Fiserv. They actually changed their symbol, so if you look and you get confused, they are now only known as FI. Maybe I can just leave it with the title, leave it and call the show over. I'll just give you the title of J.P. Morgan's report on the quarter, which was, quote, serving up another tasty print, but I'll actually expand a little bit on it. Fiserv, if you don't know it, it's basically a payment processing company, fintech, financial technology. Their primary business is connecting as an intermediary between the banks and the credit card companies, but also now as a primary provider of a point-of-sale solution for small businesses. And you might see this. It's a device called Clover. That's their brand name. You'll see it when you check out at restaurants and small businesses. Put your credit card down. You're going to slide it into or tap or whatever on the Clover device. And this is a stock, another one I own, and our clients own it, and we like it. And when I can, I try to share the negatives if I can glean them, if they're available in these reports. But I'm talking about them here, and I'm talking about them, it's generally because I have that conflict and that bias, right? Although I'll sometimes mix in a stock or two that I believe has gone too far, has a bit of a cloud over it. Fiserv is one that is still doing pretty well. Anyway, Fiserv on Tuesday announced first quarter earnings of $1.88 a share. The estimates were for $1.79, and revenues that actually came in below estimates. They only had revenues of $4.54 billion when the estimates were for $4.57 billion. And they basically reaffirmed their full year guidance, although they tightened up that range a bit to the upside, putting the Street's estimate at the low end range of the scale. They're now expected to earn $8.60 to $8.79 a share for the year, while the Street has them at $8.63. That puts them about 17 times earnings today. And that Clover business is still the growth engine, as that segment grew 36% over last year, while the overall business grew 20%, and their credit card, the traditional business, grew by about 5%. And Clover's now accounting for about 50% of overall revenue. I guess I can put a negative spin on it here, which is that if you think about what they're doing, credit card processing, point-of-sale solutions for restaurants and for retail stores, well, if that so-called soft landing hits a big bump, if the consumer is scared back a bit, well, then these point-of-sale revenues are going to take a hit directly. So they're directly tied to the health of the consumer, for better or for worse, and they're largely maybe 90%, over 80% for sure, based as an American business. Oddly, J.P. Morgan's bullish take on the quarter says that they're more confident in underlying growth trends, but that some of that is driven by international expansion. So I'm going to have to see where that is, where it's meaningful or not. Citi's analysts took the report past the first quarter. They did a little extra digging, I guess, because they said that they were further encouraged by the trends in swipes, credit card usage, in April, after the quarter. So he raised his price target to $180 a share from $171, maintaining his buy rating on the stock. And Goldman Sachs does follow the stock, but they carry it at a neutral, and they have a price target just a couple of bucks above where it's trading now. But their take on the quarter does say that they're, quote, putting up best-in-class revenue trends in merchant, led by its Clover business, end quote. And they go on to say the negativity around Argentina is overblown. And I'm not sure how it's overblown since the stock is near its all-time high and up 15% for the year. And like I said, a de minimis amount of business. But they say an issue isn't an issue, which I didn't think was an issue. So as they say, it's they went on to say it's a low single-digit portion of the merchant revenues. Anyway, Goldman's neutral on the stock with positivity around the story, but they're being conservative on valuation. And it's refreshing to see them conservative about something for a change. We still like Fiserv. Wouldn't be adding to it necessarily around these prices. There's a notion to maybe trim it a bit. So if you found yourself with a very large exposure there, that might be warranted. But overall, I'd characterize it as really clicking off of a growth engine that's humming after being developed, that Clover business being developed and taking market share over the past few years. And based on the FactSet consensus, the stock is really at the kind of lower end of its historic valuation range, while its growth is now higher than it's been over the last decade. I guess that makes me quite a bit more than neutral on it right now. But with that said, I'm also done for now. I do appreciate you taking some time to check in with us on this podcast. Hey, if you have any questions, you can reach out to us. You can reach us at our office. Ask for Simon, or you can ask for me. 571-430-7200. For the Wise Investor Show, I'm Chase Hinderstein. Thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.